As we get closer to the end of 2021, there are a number of specific tax planning opportunities that you might wish to take a look at before the end of the year. We just released our brand new and updated 2021 year-end tax tips, and it's something that would be a great reference to review before the end of the year. Let's go through some of the highlights and things that you want to think about before December 31st. Every year we talk about tax loss selling. Most people don't have a lot of losses in the portfolio this year, but if you do, you want to recognize that loss so that the trade date is no later than December the 29th, so that the trade settles by December 31st, so you can recognize that capital loss in 2021. Pay attention if you've bought perhaps securities in foreign currencies like the US dollar to take into account any foreign exchange rates when calculating that gain or loss, because depending on the timing of when you bought that security, you might actually have a gain on the FX side, even if it appears that you had a loss on the security side. Of course, you want to be mindful of the superficial loss rules. If you buy it back within 30 days, the loss will be denied. If you buy it back, a spouse buys it back, partner buys it back, corporation, trust, RSP, TFSA, any of those things buy it back within 30 days, you're going to be denied that capital loss. So just pay attention, wait at least 30 days plus one before you buy back a stock or any other position that you've sold and you wish to recognize the capital loss. RSP deadline, of course, is till March 1st. However, if you did turn 71 in 2021, you've got to make your final contribution by the end of the year, unless, of course, you have a younger spouse or partner, in which you can continue to make a spousal RSP contributions. The prescribed rate loan strategy will be available still till the end of the year. That's the 1% prescribed rate loan. So an opportunity to loan assets to a spouse or partner for the benefit of income splitting, as long as you charge the minimum prescribed rate. And just a reminder that if you have done a prescribed rate loan, you've got to make sure that you make those payments within 30 days of the end of the year. That's January 30th, 2022, which is coming up pretty soon for that strategy to work for the current year and for all future tax years. Other things to think about in particular are changes to tax rates. So in other words, if you think your tax rate is going to be very different next year in 2022 versus 2021, there may be things that you can do depending on your situation to either accelerate income for this year or defer that income to next year. You may also want to think about changes to our tax regime in general as a result of the recent federal election. We know that there are certain potential changes in tax law that might actually impact your future taxes. For example, the Liberals' pre-election proposal to tax the sale of residential properties that were held less than 1 year could result in tax payable on what otherwise would have been something that would qualify for a principal residence exemption. We also know that the NDP have a couple of proposals to increase the top marginal rate and increase the capital gains inclusion rate. Those may hold some sway with the Liberals as they put together their agenda in the months ahead. So keep in mind that there could be higher tax rates in 2022, and think about whether you want to take some of those potential gains in 2021 if it makes sense to do so. For business owners and employers, things to think about: compensation planning, that classic issue of salary versus dividends. You want to think about being able to pay yourself, in most cases, sufficient salary in 2021 to make an RSP contribution in 2022. So something to think about. We discussed this in several of our other reports, including a report called Just Do It, the case for tax-free investing, and a report Buy Bonus, which discusses compensation decisions in greater detail. And then finally, you want to think about the opportunity to make sure that you get all your tax affairs in order well before tax season. So again, instead of rushing next March or April to prepare your personal tax return, now is a great time to go through the year, review your financial records, because most of the tax planning that you're going to do for 2021 and your 2021 tax return must be done in 2021. So for example, if you've got significant medical expenses, you want to make a significant charitable donation. If you've got interest on deductible investment loans, those all must be paid by December 31st to claim a deduction in 2021. It will be too late come next spring when you're trying to file your 2021 tax return to do most of the tax planning that we talked about today. So again, Think about it, read the report, and at the end, speak to your tax advisor to recommend if any of these strategies would be appropriate for you.